All right, time to put the money in action. In this video, we are going to examine the most optimal lump sum funding scenario, which was the 4-pay option, the $1 million you wanted to pay into the policy spread out over 4 payments, $250,000 per year, examining the internal rate of return, both on the guaranteed and non-guaranteed values. Now we're going to look at that internal rate of return on the guaranteed and non-guaranteed values in this particular study, and we're going to look at using the money. We're going to focus on cash value collateral loans, which a lot of real estate investors are attracted to. And what I'll add is when we use the workbook we have provided for cash value collateral loans, we can easily adjust the interest rate. A lot of people we work with will often use this to say, hey, if I'm not going to use a collateral loan, I prefer direct policy loans, and I just want to get a quick ballpark of what it would look like, how much money can I access regarding the cash value in my policy. This workbook does accomplish that to about 90-95% accuracy. Full disclosure, this is not a substitute for an illustration or anything like that, but a lot of people we work with that just want a quick projection and then they ask us for the formal numbers, will often use this. But with that said, let's take a look at the numbers. We are going to examine things quite thoroughly, as a lot of people we work with prefer to examine things thoroughly. A question we get so much is when I flow money into a cash value life insurance policy. The past 3 videos, we talked about how to maximize the overall cash value growth. I wanted to get that lump sum of money into a policy with no payments thereafter. So now when I actually use it, what do things look like? Particularly this. What does the annual and average internal rate of return look like? And at what point in time does that exceed the net cost to borrow with a direct policy loan or a cash value collateral loan? So let's have some fun, shall we? We've got the 4-pay scenario here, where this was where we left off. The 3-pay versus the 4-pay, $1 million over 4 years. There's the $250 per year. Quick refresher, we've got the premium offset, years 5 through 7, where the dividends and interest are supporting the base premium and the cost of the term rider. Then we execute a reduced paid up option. No premium thereafter. I do see a reduction in death benefit, and things begin to climb quite nicely. There's your annual internal rate of return, isolating what I'm earning each year, and then there's my average internal rate of return. You'll notice you are in the black, no longer in the red, when we have a positive overall cash value, our break-even point, I like to refer to that as. So that is based on the company's present dividend interest rate, which in our recent historical performance videos, we've seen policies performing quite nicely that have been issued within the past 5 to 10 years in the low dividend interest rate. So that just kind of validates things look good when policies are properly designed. And then we have the guaranteed values as well. Some people like to look at this. And really my belief is if someone wants to see something, show it to them, just like they could see it on Amazon. And then compare that with the loan scenarios. The guaranteed values we have here, we ran this at the guaranteed rate of 3%. Comparing the internal rates of return, unless you can get a collateral loan at 2% or less, this rarely makes sense when I'm looking at the guarantees. But that's okay. If someone wants to see it, show them the numbers. They can prepare for all scenarios, best case and worst case scenarios. So we've got our workbooks here. What this displays is as follows. Cash value collateral loan workbook. A lot of fun here. You've got the $1 million over 4 years. There's the $250. This is the exact scenario we looked at in the past couple videos. Annual IRR and average IRR. LTV, loan to value at 95%. That's a good number to use. We can change this if we want to, but that's a good number to use if you're considering direct policy loans or a cash value collateral loan. If you want to shoot it conservative, I would kick it down to 90%, just to set expectations more conservative, but 95%, most banks will use that rate right there, or that percentage. If I've got 100 grand in cash value, my maximum line of credit at that point in time would be about $95,000 with most lenders. Some go to 93%, some are 100% with a little bit higher rate, but it depends on the lender that I'm using with a cash value collateral loan. And then with direct policy loans, typically ranges between 95 and 100%, typically, depending on the company, product, term riders, all that other fun stuff that I might have attached. So here's what we like to look at here. collateral loans, can find them at 3%. We're going to kick that a little bit higher in the event interest rates go higher, and they're higher over here. So we're going to play around with the rate. But first, let's start off here. First year is the worst year with any whole life insurance policy. Negative 17% hit in this particular example. Guardian's increased PUA fees with the 7702 change is why we see that. But still, 17% negative IRR. Next year, 0.92% negative. And then from that point forward, it's positive based on the company's present dividend interest rate. It shoots up in year 5 because I'm no longer making payments. So I have no PUA fees because I'm not paying PUA fees, no premium loads, none of that. Then it shoots up again when I execute the reduced paid up option. So as we look at this, I want to measure this compared to the cost to borrow. And you can actually do that if you know what the rate is on the cost to borrow without even plugging in any loan figures. For example, here's my interest rate, because we can find them right around 3% relatively easily right now. So if I look at the annual IRR, at what point in time am I earning 3% or greater? This particular example, year 5. If I take it in year 1, I've got a negative 17% IRR. Then I've got my cash value at 206, 3% cost to borrow. The first year, I could argue that it hurts me more than it helps me. Now, yes, this money continuously compounds, so I do make up for it over time. Some view it saying, hey, I've got the 200, that's my line of credit there, that's what I'm comfortable using, and the 3% rate, the cost to borrow is fine. I'm okay with the hit there. Depends on everyone's situation. But I do like to point this out because it is a pain point for many individuals, and it's way better to be aware of the pain points before I start a policy as opposed to finding out after the fact. So if I take it in year 4, if I'm earning an annual IRR of 1.6% and it costs me 3%, what would my net cost be? There you go. So about 1.4% in that particular example. Now, you can get quite creative with these if you want. So with the interest, if it is for business, so with cash value collateral loans, this is easy. On the lender's paperwork, I could check off if it's for personal or business use. And if it is business use, here's where you can get creative. Always work with a CPA or accountant. None of this is tax advice, but we've seen many people deduct the interest here. If it's with a cash value collateral loan, the purpose is for business, we've got the interest deduction there. Makes it very easy, whereas direct policy loans, the IRS language reads, loan interest is generally not tax deductible. We have seen some people deduct it when it's legitimately for business, the CPA works with them and such, but that IRS language states generally not tax deductible, and it's generally not tax deductible. Okay, so let's look at some models, shall we? Why don't we assume this column here, well, not assume, this is the maximum we can borrow. So if I've got $207,000 in cash value, the maximum loan I can take out right here would be what? Based off the 195, not the $200,000 in cash value, or the 196 here. So if he wants to take out a loan, let's assume it's policy year 2, LTV is 430, let's say we're going to take out $400,000. Now this workbook, because it's a cash value collateral loan, will assume we are always paying the loan interest. So what this means here is if I just plug in a loan at 3%, that's the rate, what do we have here? 400,000. Here's my loan balance. 3% of 400K is $12,000. Now this is based on an annual interest, so annualized. If we're paying any of the loan balance down over the course of the year, obviously that is going to chop down the actual interest cost here. But there we go with the 12K. Interest payment, so that's the interest due. And then here in purple, we've got the interest payment, since we will be paying it, $12,000 out of pocket. And then over here, we've got the net interest payments. I should call that total interest payments. I like to see this kind of stuff. A lot of people do. Simple column that just tallies up what's the total interest cost, not my principal payments, which we don't have in this example yet, but just total interest costs I have paid over time. And that number will vary if we do something like this. Let's assume we pay interest only, And let's assume we can change the rate every year if we want to be real creative like this. Fun stuff. But let's just plug in 4%. I'm going to make this simple and see what that looks like. 16,000. There's the total interest payments. That's bothering me. I'm just going to call it total. There we go. So let's do this. Let's put it back to 3 for now. We can make it whatever we want. And let's assume we're going to repay this beginning year 3. We can pay it back however we want. If we want to throw chunks at it here and there, 100,000, 20,000, 250. We've got 30 remaining. We can pay it back at a fixed schedule, really however we want. Very much like a direct policy loan. So in this case, we just chunked it, right? Paid it back at random. And here's what individuals like to see. Okay, so I was paying 3%, may or may not be, potentially tax deductible, depending on what I'm using it for. But now I can see when it's not in my interest versus when it is in my best interest. From a growth rate perspective, total interest cost, $30,300. We could look at this. If we like to look at dollar amounts, this is by year 6. I've paid in interest on the $400,000, $30,300. What's my total growth here by policy year 6? Now it's factoring in the full 1 million, but I paid in $1 million. I have $1,051,000. And so I earned 51. Remember, you're still earning dividends and interest on your entire cash value while we're paying interest only on the amount we pull. And that's the case with a direct policy loan as well. But in that particular example, $400K loan, by year 6, I've out-earned it, meaning the 1.11% on the full 1 million exceeded the 3% on just 400,000. Now, if I'm listening to that, I would say, okay, kick the loan up. Then what's it look like? There you go. All of a sudden not favorable at this point in time. Takes a bit longer, right? So if I look at, we got to pay it off here. So 800K, just going to do this, 100K per year. By year 10, I've earned 253, average IRR 2.69. I've paid 108. And if we pay it back slower, it'll take longer, or I should say we'll pay more interest. I think you see where I'm going here. Measuring this kind of stuff is simply what we've found people appreciate, including myself. And granted, it's not 100% accurate because this assumes I'm making loan principal payments one time per year, just throwing it all at the balance at the beginning of the year. In reality, that's going to vary with most people. So we will see a difference in the net numbers, but it allows us to get a glimpse just into what the numbers will look like. Reality, again, people appreciate it, including myself, because it can be difficult with this stuff. Anyway, before I continue to talk about my emotional pull toward life insurance and numbers, let's look at the guarantees. So, same thing here, but looking at a worst case scenario regarding the guaranteed values. We like to do this when looking at premium financing cases as well, because premium financing often it is sold as a means, hey, look what you can earn in the policy. You can outpace the cost to borrow. Positive spread, right? Let's go all day in that. I don't always like that because if the policy under-delivers and the loan rate remains constant, that's where people get into trouble there. So looking at things conservative just helps set expectations properly. Prevent any type of buyer's remorse. Let's do the same thing here. 400K. Can we do that year 2? Yep. Loan to value is 418. And what you could also do here, so I need to layer the spreadsheet, but let's assume, so you've got 400K, 900 LTV, it would actually need the difference there. These loans and policy loans function as a line of credit, not as individual loans. So what that means is if I'm paying interest only, and let's assume it remains at 3% here, what I can do to say, okay, if I've got a $900,000 line of credit there, 400K year 2, 500, total of 900,000 outstanding, the interest will always be due on the total balance. So it's not separate loans there with direct policy loans or cash value collateral loans, which is what this workbook is based on. If we adjust the interest rates here, let's make it 4%. Nothing wrong with going conservative. There we go. Okay, so I'm paying more interest here. Total interest payments. Check this out. $900,000. Should we pay some of it back? Yeah, let's pay some of it back. Why don't we pay it? Let's do this actually. A lot of people take this approach to say, hey, I'm just going to flow. You know what? I'm not going to pay it back until year 5 when I'm no longer making any more payments. I've got the $1 million in. And then I'm just going to flow, call it $60,000, $5,000 per month toward the principal in addition to paying the interest for the sake of simplicity. One more. There we go. So looking at the guarantees here, what do we got? This gets interesting. So I've paid at a 4% rate, $280,000 in total interest. I've pulled $900,000 total for opportunities. I paid $1 million into the policy. These internal rates of return are based on the full $1 million. And again, we can argue any kind of numbers we want to make one scenario look better than the other. So don't take this as an attempt to say, my way's the best. I don't like that kind of stuff. But here's what I would look at. I paid in $1 million, got 1.267, call it 127. Over here, I paid $280,000 in interest. So I could say, I paid in $1 million. I paid out of pocket another $280,000 in interest, assuming there's no tax deduction there. At this point in time, my cash value is 127. I paid in 128, negative $10,000 spread. There's a deduction. That's great. Keep in mind, these are with the guarantees. It's always done significantly better than that when well designed and with one of the top companies. But if we do the same scenario here, the non-guarantees, and we can run a middle-of-the-road dividend as well, which is always fun to do. Perfect. So same 280. So I've paid in $1 million plus $280,000 in interest costs. What do I have over here? 1.8. So how a lot of people view this, just through experience and speaking with them, is I've outlaid 128, and my cash value is 1.8, almost 1.9. Okay, I'm good with that. Now granted, I pulled out $900,000 and paid in $1 million, so we can make the numbers not in favor of this too, as we play around with things. And again, my point here is not to say one strategy is better or worse, more so providing transparency, and this way we can actually study it, examine it, and make the decision for ourselves, with our advisors, whoever. In any event, I hope you enjoyed this case study, all of the case studies with the lump sum funding. I always like going through this stuff. It is a ton of fun. But if you did, please hit the like button, subscribe for more. Feel free to reach out to us anytime if you'd like to see any custom illustrations, policies, take out a policy. That's how we drive our business, by working with individuals and helping them with this stuff over the years. Our team is great. They're better than me. And I mean that sincerely. But in any event, thank you so much again. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.